Hello everyone, my name is Michael AMAT. I am the founder of ChartYourTrade.com, and I wanted to talk to you today because the markets are starting to get a little bit wonky, and there's been a lot of concern that I've seen all over my stock twits and my Twitter feeds, so I wanted to try to put some of those concerns to rest. What we're looking at right here is a chart of the S&P 500. We have the daily chart up here. We have a longer term weekly chart down here. And all these little flags that we're seeing on the daily chart of the S&P 500, those are flagging distribution days. A distribution day is any down day of 0.2% or greater on heavier volume than the prior day. And it's important to look at distribution days because it's a sign of institutional selling coming into the marketplace. Now, on the S&P 500, we've seen the number of distribution days climb fairly rapidly. Right now, the distribution day count on the S&P 500 stands at 10, which is a lot by any kind of measure, and we've seen them pile up pretty rapidly over the past couple of weeks. When they start to cluster like this, it's problematic, and that's one of the reasons why there's been some concern out there from many investors. So one thing that's important to point out, especially when we look down here at the weekly chart, it's more pronounced on the weekly, so I like to look at the weekly, is right after the election, we've been running non-stop, and this is really the first time that the market has paused to consolidate. So we ran for about 12% over since November. So what was that? That was about 3 months at that point, and we've only really been consolidating since the beginning of March. So considering the kind of run that we've had, that's not terrible, and we're also seeing the S&P 500 find support along this 10-week line on the weekly chart and along the 50-day moving average on the daily chart. So I'm not too worried yet. What I also like to do is compare how the S&P 500 is doing against the NASDAQ and against the Russell and other indexes. So I'll pull up the QQQ here. I like to use the QQQ because it gives me a sense of what the volume is. On this particular platform that I'm using, TradingView, they don't have volume bars for the NASDAQ or for the Russell, so looking at the ETFs gives us a pretty good sense of what's going on. So distribution is less of an issue here. It's also getting support at the 50-day moving average. And on the Russell, or the IWM, the ETF that tracks the Russell, they've been fighting against the 50-day moving average, but have really just been consolidating sideways here for the past several months. And we're seeing distribution become less of an issue on the Russell. Right now, the count is only at about 5. So when I'm reviewing the indexes and I want to try to get a better feel of what's going on, I like to look at what's going on underneath the hood. And by what's going on underneath the hood, I mean what are leading stocks doing. So we developed this ChartYourTrade MRI scanner, and it hunts for the best of the best growth stocks in the market at any given time. So as of last week, the scanner runs every weekend. It produced 74 results, and that's the highest that I've seen in quite a while. So as more stocks pass our scans, and these scans are dynamic, we have some scans that focus on fundamentals, but we also have a number of scans that focus on technical strength, like the relative strength scanner, like the near a 52-week high scanner, sector leaders. So the scans are dynamic, and as the number of stocks, as more and more stocks pass these scans, it's an indication of some strength underneath the hood, so to speak. So to see 74 stocks pass, to me, that's an indication of maybe we're going to set up and continue running at some point. If the market confirms and breaks out, this is how I personally go and start to gain a little bit more of a flavor of, should I be a little bit more bullish or should I be a little bit more bearish? Another thing that I always like to consider is the number of new highs versus new lows being made on the NASDAQ and on the NYSE. And the reason why I look at those two particular indexes is because that's where the majority of stocks trade. So it stands to reason that the market needs new highs in stocks in order to continue higher, and if the number of new highs dry up, then it's an early indicator that we may roll over. And the same thing with the number of new lows. If we continuously make new highs in the market and then we start to see the number of stocks making new lows begin to bubble up, it's an indication that something's not quite right. So we want to see the number of new highs trump the number of new lows being made as on both of these indexes. So on the NASDAQ, we could see that there was a little bit of trouble in paradise last week, where the number of new lows started to beat the number of new highs. That's over the past couple of days, it seems to be resolving itself. The NYSE is doing much better in this regard, with the number of new lows being in the single and low double digits for quite a while. So with seeing a lot of stocks pass these scans and the number of new highs versus new lows being okay on the NYSE and starting to improve a little bit on the NASDAQ, we're still in kind of wait and see mode, but my overall bias is still bullish, where I'm willing to put on new positions, and if a stock breaks out of an advanced pivot, I'll take a stab at it. And if a stock is pulling back into a major support level, then I'll take a stab at that one as well. So one that's caught my eye, and I actually took a position on it this afternoon, was AMAT. And the reason why is because it's in the semiconductors sector, and semiconductors are still very strong. What we're looking at right here is an industry group rotation report, and it shows the number of stocks passing the scans, how many are within each industry group. So semiconductors has been at the top of this for quite a while. It got bumped by regional banks last week. A lot of regional banks coming on, but when we look at what is it called? AMAT, Applied Materials, we can see here that it's been running for a long time. It's starting to form a flat base, and it pulled right into the 50-day moving average. So in this kind of environment where there is a little bit of strength bubbling under the hood, and we're seeing the major indexes find support, and this is a leading stock in a leading sector, and it found support at the 50-day, I'm willing to take a stab at this with a relatively tight stop right around the current lows, just below the 50-day, and see what happens. You know, we're really only risking just a fraction of a percent on this for it to slice below the 50-day, and the upside potential is incredible. So let's let's just assume that this works out to be a flat base, and we our price target is 20 to 25% above the pivot of a flat base. That puts us around $50 a share. So entering here at 37, I believe my entry price was 37.79. So from this point, with a stop just below the 50-day, if it were to rally to 50, then that gives me 41R, which is 41 times the amount that I risked, because I'm really only risking about 30 cents on this trade. So risking 30 cents to make potentially $12, I'll take that trade every single day of the week, especially on a stock like this. Will it work out? That remains to be seen. I might be stopped out tomorrow, but for that kind of a risk reward, I'm willing to take a shot at it. So anyway, I hope this video was helpful, and please take a moment, let me know what you thought. Leave some comments in the comments section if you're looking at this on YouTube, and make sure to hit the like button. Thanks so much for watching, and we'll talk to you again soon.